Going. Okay, welcome everyone to today's webinar hosted by the Oregon Office of Rural Health. I'm Rhonda Ann Gerst, the RHC Program Manager. The webinar you are attending today is titled RHC Cost Reporting 101, presented by Julie Quinn of Health Services Associates. Julie Quinn is Vice President of Compliance and Cost Reporting at Health Services Associates. Julie is a CPA with over 25 years of experience in governmental compliance and cost reporting, 15 of which she spent in the Medicare contractor arena. She holds an MBA with a concentration in healthcare administration. She assists RHC with cost reporting, audit resolution, rate setting, and other cost and compliance issues. Before we begin, there are a few housekeeping details. The webinar will be recorded. The slides and recording will be posted on the Office of Rural Health website within the next few days. Thank you to Sarah Michelini, who is our tech support during the webinar. If you encounter a technology problem, enter your question into the chat box and she will assist you. As you know, we are at the mercy of good bandwidth. If you have an audio or visual problem, you may want to leave the webinar and rejoin. You are all currently muted and your video is off. Julie will be happy to answer questions at any time during the presentation. You can ask a question by raising your hand or, and I will unmute you, or type in the chat box and I will read your question. Without further ado, I would like to present Julie Quinn.
Thank you, Rhonda Ann. Well, we're going to take this morning and talk about just the best subject in the world, expenses, cost reporting, numbers. I know for someone like me, the bean counter of the world, I get it. These are great topics, but for some of you, it is just nails on a chalkboard. So I'm going to try not to be the typical accountant. Everyone that knows me knows I'm not a typical accountant. A little about me. I live in North Georgia, near right on the Tennessee line. So if you hear me saying afternoon, it's because it is my afternoon. The afternoon right before vacation. So you will also see me nursing my cold with my Minnie Mouse mug, because tomorrow I sail on a lovely Disney cruise with my family and my granddaughter. So I am so looking forward to that. But before that, I would love to teach you guys just a little bit about cost reporting. Rhonda Ann, could you give me a head count? How many do we have today?
Let's see, we have about, 16
Perfect.
Currently on.
Okay.
Yeah, and you've got some provider-based and independent both.
Okay, it's good to know. With 16 people, I feel like that's a great little group where if we wanted to just stop, take questions, have some interaction, let's do that. I would rather do that and you understand where we are, what we're doing. And if I think that it's something that we're going to get to later, I'll just say, okay, we're going to throw that in the parking lot for just a second. And if we don't address it with slides after that, then we will pick that question back up. But again, I apologize for the nasally sound. I am nursing a lovely winter cold that I really hope that the Atlantic air will get rid of this weekend. So to get started, first get you off of my picture. What are we going to do today? Okay, the first thing that we want to talk about is why you have to do it. Then we're going to go to what you need to complete the cost report, because let's face it, most of us don't complete our own cost reports. If you do, be very careful. Make sure you know what you're talking about. But if someone else is doing it and they're not asking you for the things on this list, you're going to want to know. And then once you get it back from them and they say, okay, you need to sign this, so you know what you're signing, so you can look at some common cost report calculations and know what you're reading and know what you're looking at. All right, why, when, how? First of all, why? Because they will cut your payments off. Medicare, and we're going to talk about this from a Medicare perspective. It's my understanding that there's no annual requirements in Oregon that are required to be filed each year. There's some rate setting if you're new to the program, but for the Medicare portion, If you are independent, you file on your own. If you are provider-based, you are a chapter within the hospital's cost report. They are due 5 months after your clinic's fiscal year end, and they are required on a vendor-approved software. No more handwritten things. That's been gone for a couple decades. And yes, I was in it a couple decades ago, of course, on the other side, accepting those reports as a Medicare auditor, but it's been a very long time since those happened. We are still allowed to do hard copy wet signatures with wet signatures on the independent side. We expect that to go away sometime soon. Okay, what does it do for me? We know why we have to do it, because they'll cut your payments off. When is it due? 5 months after the fiscal year end. What does it do? First of all, I want you to understand that a cost report is a lot like a tax return. When you put claims through the system, you are just getting a tick mark in the "we did a visit" column, and you're getting some interim payments through that claim. But at the end of the year, this is where it's all trued up, and we find out who owes who, if you've been overpaid, if you've been underpaid. This reconciles that interim payment system to what you really are owed, or whether you owe Medicare back. It also determines what your future interim rate is going to be. And then lastly, it's where you get paid for. We call them pass-through costs, because they are your pneumococcal and influenza vaccine costs, of course, COVID right now as well, and also your Medicare bad debt. So it's where you get paid for your pass-through cost. Okay, I understand I have to do it. I understand it's due 5 months after the year end. It's where they reconcile me. It's where I get paid my pass-through for my vaccines and my bad debt. But I just don't understand the concept of what this means. If you hear one thing today, you're going to hear it many, many times. Anytime anyone hears me talk about this, I'm a boil it down kind of gal. Cost divided by visits equals your rate. And there's some caps onto that. RHC cost divided by RHC visits equals your RHC rate. What does that mean? Is that what I get? Okay, so now we're going to break you into two groups. Independent. You can be owned by a hospital and still be independent, by the way. You would need to ask your hospital, do you file as an independent or do you file as part of their report? Most of the time, if you're owned by a hospital, you're going to be provider-based, though. But independent, filing independent, we used to have some low caps, $87. I've seen them, low 70s. They've creeped up into the 80s. And then along came the legislation that got caps increased in a rising cap that went to $100 back on April the 1st of 2021. It's rising through 2028 when the cap will be $190. For provider-based, if you were attached to a large hospital, a greater than 50-bed hospital, you had those same caps. If you are a provider-based attached to a smaller hospital, before this legislation came out, you had no cap. You got your cost divided by visits equals your rate, and that's what you got. You got your cost per visit every year. Now, you are capped, but it is an individual cap that is based on your actual cost per visit from your reports ending in 2020. So if you're a 6/30 or a June 30 report, that June 30, 2020 is your base year, is what we call. If you are a normal calendar year end, 12/31, 2020, whatever year end ended in 2020, that is your base year for your cap, because it is an individualized cap. So for your independents and provider-based attached to large hospitals, these are the caps. They used to be, just to kind of give you some history, 87, 52, 100. We are now in 2023, so the cap is 126. We go up $13 a year till we get to 190. And then we start increasing by the MEI, by the Medicare Economic Index. But for provider-based, your cap is whatever that 2020 actual cost divided by visits equals your rate, actual rate was, and then indexed up each year by the MEI. Provider-based attached to small hospitals, you have an individualized cap based on 2020. Independent and large hospitals, you have these caps. These are maximums. This is not what you get. Please let me make sure everyone understands that next year the cap is 139. That does not mean you get 139. It is cost divided by visits equals your rate subject to a ceiling. You're going to bump again. This is your ceiling. So you can't go higher than it, but you can go lower. It is your actual cost to the ceiling, whichever is lower. So that means we have changed our focus. So let's talk first. Again, I've got you in a couple different camps right now because for this piece, it matters what your designation is. So independence. So each year our independence, we had that wicked low cap, 87, 83. I mean, it's been ridiculously low for a long time. So each year our independence, our focus was making the cap. And I just thought this was funny. I do these presentations and I do these auto designers and it picked a graduation cap. And, if we can't laugh at what the computer gives us, all I can say is maybe we're graduating to some better caps. The independence, we used to focus on make the cap, which is actually a ceiling. Just make sure my cost per visit, cost divided by visits equals your rate. Make sure that you maximize to the cap. In the future, because remember, we're going here. We're going in 2026, we're going to be at 165. In 2028, we're going to be at 190. And I'm just telling you, I don't have a lot of independent clinics that are going to get to 190. Their cost is not that high. I feel like you guys are going to land about where your highest commercial payer is paying you, because we are not like the government. We can't spend money we don't have. We have to live within our budgets and live within our means. And so if our other payers are maxing out about 140, 150, that's about all we can spend without going into debt. So I just be aware these are caps, not actual payments. Your rate is not going to 190. It is going to max out at 190, but it is actually your cost per visit. So in the future periods, really what we want to do is find your sweet spot. We want to find out where you can sustain cost divided by visits, that rate, and keep that consistent year over year. So if you guys see big swings, my advice, I'm going to just give little nuggets throughout this presentation. If you guys see big swings, you had a practice close across town and a large influx of patients, let your finance team know. They need to know that can affect your rate. It could cause a payback because this is cost divided by visits. So if visits goes way up, that cost per visit is going to tank a little bit. And where we want to do is we want to keep consistent to avoid large payback. So let's flip over here to the provider-based. They also have a change of focus because it used to be we get paid what we spend. Whatever our cost per visit is, that's what we get paid. No cap. Now, as a provider-based, you have your individualized cap that is based upon that 2020 cost per visit. And you guys are also going to find your sweet spot. You're going to find a target. You're going to find an optimal cost per visit that will maximize the cap without going too far over. Because your cap is not necessarily, it's not climbing. You know what your cap is. It's from 2020, and that could be 285, 225, whatever your 2020 cost report says, that's your base year. Then you're going to get a 1 to 2% increase each year over that. So you guys know where your target is. You know where you have to hit, and you don't want to go too far over it, or you're going to be leaving money out there. Cost divided by visits equals the rate. I'm going to throw this in there several times, because if you can understand this concept that cost and visits equals your rate subject to a cap, you're 60, 80% there. All right. So those are the concepts. Let's talk about the report, what it looks like, where these things are located. If we're looking at a cost report, you're going to see, and again, two camps here. We've got the independent camp and the provider-based camp. If you're independent, we're going to go ABC. If you are provider-based, M123. Because the M chapter, the M series within your hospital's cost report, that's where you live, and it is almost identical to the ABC's worksheets that are in an independent. It's like they plucked that M series out, independent, or vice versa, put an independent in to a hospital. They're very similar in what they have on them. So you'll see me use A and M1 synonymously because one is an independent form, ABC, one is a provider-based form, M123, but they have the same information on them. And worksheet A is where, and we have some sub worksheets for worksheet A where and actually on a hospital cost report, they use the A series of that to get these things done. But let's say so we have some costs that we need to move around or pull off or put back on. We do that through some sub worksheets of worksheet A. So basically, when we're talking about it, we have cost is on A, because remember, cost divided by visits equals our rate. Cost is on A, and if we need to move some things around or take some things off, we use those sub worksheets. Visits is on B and M2. And the rate, that settlement process, that tax return, if you will, who owes who, happens on C and M3. And then we also have a sub worksheet B1, M4 for the provider base, and that's where those pass-through costs for vaccines are calculated. So cost, visits, rate, A, B, C, 1, 2, 3. Cost, visits, rate. All right.
Julie,
Yes, ma'am.
we have a question.
Yes.
Okay. We are not yet an RHC. We will be provider-based attached to an 18-bed hospital. How will
Okay.
CAP be determined if we were not an RHC in 2020?
Okay, so I think that they're still working that out, honestly, at a national level. But here's my theory. Here's what I think is going to happen. I think that they will set you at your first full year cost report and use that as your base year. All right, is that helpful?
He said, yes, thank you.
Okay. Everything I've read, that's where that's going. Okay. So and thank you for stopping. I would rather address it as we go. And again, I'm happy to interact. It's a lot easier also when I interact and can see whether folks are getting it. I love to do live presentations. That's not always feasible for everybody, especially with the technology making it as easy as it is right now for you guys to enjoy this from your desks. So let's just say, okay, I get the concept. I get that it's cost divided by visits equals my rate. I got a ceiling. I know what that's all about. I am not going to touch it with a 10-foot pole. I'm a CPA and I don't do my own taxes anymore. There's a point in time where it just is, even though you know what you're doing, you got to let somebody else keep up with the nuances. And if that is you, and whether it's your hospital team that does it, an outside consulting firm that your hospital or your clinic hires to do it, you still need to know whether they're asking you for the right information, whether you're getting what you're getting back, and how to read it. So that's really where we're going to spend the rest of our time. If I were getting ready to do a cost report and I wasn't doing it, somebody else was doing it for me. Here is the information I should expect to have on my desk in a packet to give to them. Electronic, of course, these days. Please don't mail me anything. Love, love, love where we are with the electronic. There's 3 slides to this. This is a list. You will get these slides if you haven't already. This is just information gathering. Got to have financial statements, including your depreciation schedules. You have to have your visits by practitioner. Now we're just gathering all of the grains that go into this bread, okay? The financial statements, the visits by types of practitioner, the clinic hours of operation by day, FTE calculations, we'll talk a little bit more about those. total number of clinical staff hours worked in the cost reporting period. We're going to make sure that we have salaries by employee type, that we have our logs that go with those pass-through vaccines we talked about, the influenza, the pneumococcal, and the COVID. We have to have logs, and for pneumococcal and flu, you actually have to keep a hold of those invoices. We've seen an uptick in the audit of the vaccine costs and them really looking at the invoices and logs lately, at least in our client base. Telehealth volume and time if you kept it. CCM volume if you did it. That's chronic care management, CCM chronic care management. Those are specific Medicare codes, specific Medicare activities, and then related party transactions. And then lastly, again, we're just getting a packet together. We're just getting the stuff together to make this report. Medicare bad debt, and that will be the last thing we touch on today. Laboratory costs and data, because they have to be carved out. X-ray, and then your PSNR that is obtained online through Medicare. I just gave you a really long list of stuff you need to make sure you have. And what I'm going to try to do is tell you why you need it. And then where it goes. All right, so we've got our packet. We understand the concept. We've got our packet together that we know. We gave it to our cost report folks, and they gave us this report back and said, please sign. But I want to be sure what I know what I'm signing. I know what I'm looking at. So let's take a few minutes and go through the ABC 1M 2 3 and just how it flows and what you're looking at. I didn't mention this before, but before the 1 2 3, there's S. S is for statistics. It's just where you put your name, who you are, who you're related to, hours of operation. It's S and then ABC and 1 2 3. It has some questions on there about malpractice insurance. Is it claims or occurrence based? It asks you about your clinic hours of operations. The clinic hours of operation you're going to put on there, put patient care hours. So if you've got some admin only hours on a Friday afternoon where you don't see patients, just business office hours, that should not be included here. This is hours available to see patients. If you have non-RHC hours, there is a section for your RHC hours and a section for hours you operate as a non-RHC. That's tricky. If you're going to do that, please talk to someone who really knows what they're doing so you can do the carve-outs appropriately. And the time is reported in military time format. There's a questionnaire that's built in there, so they may ask you some other questions. It used to be in the old 339. We're talking, yes, I'm an old enough to have lived through the old 339 questionnaires, and now they finally don't make you do two. Several years ago, they embedded it. So in that S series, again, before we get to the 1 2 3 ABC, they're going to ask you some questions. They're also just going to ask you to really quickly go through and say, break down your visits. And we're going to put visits in a couple other places, and all these have to match. But the first stop is to put it on S3, and they want it broken down between what you did physically, medically, medical visits, mental health visits, including mental health, telehealth, and interns and residents. That you actually have to break it out into these categories. Change this year. I hope everyone is aware, but if you're not, let's review it again. Mental health, telehealth, effective 1/1/22. So we're talking a year ago. Mental health, telehealth became a visit that is paid at the all-inclusive rate. So that rate we talked about, sometimes you'll hear that synonymously called an AIR, which is an all-inclusive rate. It used to be that mental health, telehealth was paid at this side rate, this telehealth rate. And effective 1/1/22, mental health, telehealth got folded up into it. It became a regular RHC visit. It's paid at the AIR. It is included in total visits. So what does that mean? First of all, if it is mental health, telehealth, or an in-person visit, we're going to count them. If it is physical telehealth, it is non-RHC, and we are not going to count it. And we actually have to do a carve out for that. So what is mental health, telehealth? So I've talked to some people at a national level, and here's where we are today. To do a telehealth and get paid at your AIR and for it to count as a mental health telehealth, right now CMS has only identified the 900 codes with a mental health provider as a mental health telehealth that qualifies being paid at the rate. It does not include a physician doing a telehealth visit for a patient that primary diagnosis is anxiety and depression. That is a revenue code 521, and it is paid at the telehealth rate. I know that NARHC is working on that. They hope to get some clarification and get some of those mental health codes qualified to pay at the AIR if done via telehealth. But right now, here's where we sit. Only these 900 codes, these 90791 to 90845, your actual mental health providers that are doing these telehealth, these are the only codes that are going to bump up into the AIR. You count them as a visit and they get paid at the all-inclusive rate. They get paid at your RHC rate. So what does that look like? So I am going to just throw this slide up there because I am not the billing expert at HSA. We actually have another Julie, if you were to ever have billing questions for us, that answers these. And she gave me this lovely slide with examples. So for those of you that are billing experts, I hope this makes more sense to you guys. What I know about it is that when you do different kinds of visits, there are different modifiers. So you'll see an example one, in-person RHC mental health visit, gets the 9,000 or the 90832 code with a CG. When it is video, it's a telehealth mental health, it's a CG 95. Telehealth audio only is a CGFQ. I hope this is helpful to you, giving you the modifiers on how, just some examples maybe on how to bill these mental health telehealth and get them paid at your visit. Okay, so while we're still just on S, I promise we'll speed it up here in a minute. S3 is the last place that we're just giving some general information, and visits is part of that. And we actually have to break it down by Title V. I have no RHCs that have this. I don't know if you have any. I think you would know it if you were doing it. The Maternal and Child Health Services Block Grant. Title 18, that is red, white, and blue Medicare card. That is not Medicare Advantage. This report is for, when we talk about Medicare, we are talking about red, white, and blue card Medicare. Title 19 is Medicaid, and other is commercial self-pay. Medicare Advantage goes in the other column. So back to the Medicare, let's just go over that again. It is regular Medicare, it is not Medicare Advantage, and when the day is over, it has to agree with the PSNR, which is, it's actually a Medicare claims summary report. So even if you were to say my Medicare visits were 3,500, if your PSNR says 3,502, I have to force it to match the PSNR, or I get fatal errors when I do this cost report. All right, so we've given them all kinds of information. We've filled out the questionnaire. We've told them what our visits are by type, by insurance. Now let's get down to the cost divided by visits equals our rate. Remember, cost is on A, visits is on B, the settlement, the rate is on C, and that is M1 for cost, M2 for visits, and 3 is the settlement pieces. So what do you need? This is where we're going to pull out this profit and loss statement, the balance sheet, the trial balance, and make sure that it agrees. Again, we're in the review process now. We got it back. Somebody's told us to sign it. What am I looking at? Look at worksheet A, worksheet M1. Does it agree to my departmental financials? Does it agree to the financials? Do the expenses, are the expenses appropriately reflected there? For new clinics coming in, just a note, if you're coming in and you're going out, you might have some short periods. For most, it's just from the first of your period, cost reporting period to the end. The financials have to match your cost reporting period. It's simple, 2 columns. Compensation goes in column 1, everything but else goes in column 2. It is that simple. And then the other columns are feeding from those sub worksheets. But what you are looking at when you are reviewing is column 1 and column 2, and then the total. Does that agree to the expenses that I have for my clinics? So you've got your cost report, you've looked, your total expenses agree, you ticked in a few numbers, it pretty much agrees, but I don't understand this. I don't understand what they've done or why they've done it or why it even matters, where I put cost, what is this upside down blue triangle that you're showing me, Julie? I love the inverted triangle because it shows you where we want costs and how this report works. If you're looking at if you're looking at the M series, the top is healthcare cost, the middle is overhead, and the very bottom is non-RHC. So what goes in healthcare cost? Things like your healthcare compensation, your supervising physician, your medical directors, your medical supplies, your malpractice license. You could have some professional dues and subscription. Again, your medical supplies, your flu and pneumo vaccine costs. Transportation only if it's between clinics. Okay, that's the top. We have healthcare cost. Then we have overhead. There's 2 types of overhead, facility and administrative. What goes in facility overhead? Well, facility building, you can kind of deduce what would go in there. That's rent, it's insurance, it's interest, it's your things to run your facility. Administrative overhead is your office salaries, your legal, other administrative costs, your office supplies, administrative overhead. So we have our healthcare cost at the top. We have our overhead broken down by facility and admin in the middle. And in the bottom, we have non-RHC. And here's why it's important. That middle section, that overhead section, will allocate itself based upon the ratio of healthcare cost to overhead. If you added healthcare and overhead together and the healthcare cost is 60%, then 60% of the overhead, and I'm sorry, let me say that again. Overhead allocates itself based upon the ratio of healthcare cost to non-RHC cost. And non-RHC costs are the things that we carve out. There are 5 things that we carve out. We're going to pick them up again later, but let me just say them. If we have cost, we have the cost excuse me, cost divided by visits equals our rate. RHC cost divided by RHC visits equals our rate. But anything that is paid outside of the rate, over and above the rate, differently than the rate, can't be in cost and can't be in visits. So the cost has to be a non-reimbursable. So X-ray, a technical component of lab, X-ray, and EKG, your CCM cost, and your telehealth, your physical telehealth, those are all paid outside of the rate. You bill Part B for lab, X-ray, and EKG, or through the hospital for your hospital-based. Anything that is paid outside of the rate, the cost can't be in the rate. So it's in this non-reimbursable cost center. So overhead is going to allocate itself based upon your RHC cost to your non-RHC cost. So what kind of things go down in non-RHC cost? Things that use overhead is what we're going to leave there. The most common things, again, things that are paid outside of the rate, technical component of lab, X-ray, EKG, CCM and telemedicine, other items that are not covered under the program or that are paid outside of the rate. If it's paid outside of the rate, if it's paid differently than the rate, we have to get it out of the RHC cost. And we only want to leave it there. This is important if you are looking at your cost report, if you want it to capture overhead. So, and I'm just going to stop there and I'm going to get into it a little bit more about how to decide whether we're going to reclassify a non-reimbursable cost down in here because it should capture overhead, or just pull it off the report altogether. Things that are paid outside of the rate can't be in the cost, and you don't count it as a visit if it is not paid under the rate. So we're still on A, expense reporting. What doesn't belong? Miscellaneous revenue, you have to look for that to pull off. So if you have medical records income, you've got to pull that off. If you have interest income, you have to pull that off. some other costs that are non-allowable advertising. So for advertising, the easiest thing for me to say is if it is for staff recruitment, if it is for patient education, that's allowable. But just merely to increase utilization, that advertising cost is not allowable and it has to be pulled off. For taxes, if there's no exemption available for state and local taxes, then yes. But income taxes in general, no. That you do not, they are not includable as expenses. Fines and penalties are also not allowable. Okay, so we've got all our stuff on A. I wanted to step just for a second into these sub worksheets. I know we're getting way down in the weeds here. Hang with me. Are there any questions, Rondianne?
Nope, not right now.
Some people who have been doing cost reports for a while are going to get this. They understand. We have A, we have things that are paid for outside of the rates. We've got to do some different stuff with them. I guess that's the easiest way to say that concept. Because if it's not paid under the rate, it's got to go somewhere else. So what do we do with it? On worksheet A6, if we have some things on A up in that rural health clinic, that healthcare cost center that maybe belongs to a non-reimbursable cost center, we might have to reclassify it. We might have to exclude it. We use A6 to reclassify, we use A8 to exclude. All right, so what kind of things? We're going to go back over it again. Things that are paid outside of the rate have to come out of the cost. We either have to pull it off the report altogether or move it into a non-reimbursable cost center to grab some overhead. We either remove it or we pull it so it will pull overhead. So what are the things that we have to pull out? I make this simple. As simple as I can make it is if it is paid outside of the rate, we're going to do something different. Lab X-ray EKG. If you are independent, the technical component gets billed to Part B. You get paid separately for that. So the cost of that technical component has to go somewhere else. If you're a hospital, that is billed through your hospital. The technical component of labs and X-rays and EKGs is billed through your hospital. So we have to pull out any cost related to providing that service. There's a couple of ways we can do that. The way, again, I'm a boil it down kind of gal if you ever met me, just trying to make complicated issues as simple as I possibly can. And so what we basically came through and said, okay, how do I carve it out? Time the test or time the person. Because most of our rural health clinics, when you're talking about lab X-ray and EKG, most of them, we have a few large ones that might have a dedicated lab employee or a dedicated X-ray employee, but most of our clinics, people wear multiple hats. They might run labs, but they're also rooming patients, they're also cleaning the rooms, they're also helping. And if their salary, if they're making $40,000 a year, what percent of that needs to go down in that non-reimbursable cost center? Not all of it, because they do multiple tasks. Time the person, time the test, because your goal is to figure out how much of that person's salary you need to pull down into that non-reimbursable cost center. Same thing with CCM and telehealth. We're going to pull that if they're done internally. CCM is done internally and the people are doing a little bit of CCM and they're doing a little bit of other things. You are going to use these same calculations, time the person, method A. You can either have them keep time studies or run the number of tests they did by an average time it takes to do that test. Again, you're trying to get hours worked so you can pull out a portion of their salary. And then you're going to reclassify that staff cost and you're going to report that directly into the non-reimbursable cost center. Chronic care management is a little bit different in that chronic care management, so we talked about, do we need to pull it off the report or do we need to reclassify it? And remember, overhead allocates itself based upon RHC to non-RHC. So you only want to leave money down in this non-RHC cost center if it needs to grab some of your water and your lights and your overhead. So because these lab folks, they're in your building, they're doing this stuff right there. Yeah, we got to leave it there. They got to pull a little bit of the break room, a little bit of the water, a little bit of the lights, a little bit of the office supplies. You have to leave them there. CCM, chronic care management, is often outsourced these days. Is what about 50-50 is what I'm seeing. And if it's outsourced, or let's say I did one a cost report last week where the hospital staff did the CCM, and that cost did not get allocated. It was not direct alloc. It was not even in the RHC cost. And the people don't sit in that building. They don't use the water, the lights. They shouldn't catch a piece of the overhead. So we pull CCM if it's done by an outside company or a parent company. But if it's done by your clinic staff, then we have to carve out a piece of that staff's time for the CCM and it stays down in that non-reimbursable cost center so it can grab some overhead. Telehealth, I'm not going
Julie,
to go. Yes, ma'am.
another question.
Yep.
How exactly do you calculate CCM? Is it by specific code dropped for CCM visits?
So okay, so let's go back up to here because here's kind of the methods: time the test, time the person. So you can either have the person doing CCM keep up with the amount of time, like time the person, have them do time studies. But for most of our clinics, we do the method B, which is time the test. We use that threshold to bill, which is 20 minutes on a CCM, run a report of CCM codes, and multiply it by 20 minutes. Let's say we get 150 hours, and then we multiply that by an average hourly wage. Because again, we're trying to get wages to pull down. Run your codes. We use the threshold to bill of 20 minutes. Multiply that by an average hourly wage. Same thing you would do for lab x-ray or EKG. If you do EKGs, run the number you did by the average time it takes to do an EKG, 10 to 15 minutes. Multiply it by an average hourly wage and pull that down. That's if it's done in-house. Is that helpful?
Yep, she said thank you.
Okay. Telehealth, I'm not going to go over the what's and the whys. We all know PHE, we're doing it, and that it's going to go away, or that it's scheduled to go away in 24, but we think it's going to stay, all of that. Here's where we are. Right now, medical telehealth is paid outside of the rate. It is paid at that 97-ish dollars. It is paid outside of the rate, so we have to pull the cost of doing it into a telehealth cost center. There's actually a telehealth cost center in that non-RHC section, line 79 for independent, 2501 for provider-based. And it is literally just pulling down some of the salaries of the folks that are doing the telehealth down into that telehealth cost center. Some other possible additions: depreciation. Just remember, it has to be straight line. Talk to your accountants on the differences of those. There's actually ways to calculate that. Straight line is just its useful life. It's value divided by its useful life. No accelerated methods. So another cost addition for sole proprietorships and partnerships. This is mostly on independents. We can add the value of your compensation, whether you paid it or not, if you're a sole proprietor or partner. Some things that you should look for exclusions is entertainment, gifts, charitable contributions, automobile expense where it's not related to patient care, some offsets. These are just for information, things that you might be looking for: interest income, medical records income we mentioned, income from space rented to others, unless you can directly identify the cost. So if you have a specialist coming in and they don't use your people, they don't use your supplies, they just come and use one room one day a week or one day a month is usually what we see, and they pay you $400 a month, make sure that income is offset on your report, and any other miscellaneous income you want to review for a possible offset. So we are still in expenses. We're almost done. This is one of the auto-generated designs that I kept along with the graduation cap, because it says party and PowerPoint thought we were having a party. I want to tell you that related party has nothing to do with parties. Related party transactions is related organizations, related entities, related people transaction. They're going to adjust. It's not just necessarily reduce, adjust to the cost of ownership. The most common things we see is when a building is rented from the clinic owners. So I own the building. I also own the clinic. And because of tax purposes, my tax accountant told me to set up a holding company and rent it to myself and all of that. When we get to this cost report, we have to wipe out the rent and add in the actual depreciation and property taxes, the things from my personal Schedule E is usually what we see. It doesn't have to be reduced. If the clinic couldn't pay the rent, maybe it's an addition, not just a subtraction. Maybe it's an addition of the costs that it costs the owner to own that building. It's not always a reduction. It's actual cost to the related party, which again has nothing to do with parties. It has to do with related persons, related organizations. Okay, cost. Remember, we got it in the right categories. We have RHC, overhead. We pulled a little bit down in non-RHC. If it did not take overhead, if we don't think it uses overhead, we're going to pull it off the report because we don't want it to capture any of this overhead. But if we think it should capture some overhead, we're going to leave it down there. Top 5, lab, x-ray, EKG, telehealth, and CCM. Those are the things you're looking for. So our cost looks good. Cost divided by visits equals our rate. So where do visits go? Visits go on B, M2. It is broken down by provider type. Please know that first blue box. It is a face-to-face encounter with a qualified provider, not nurse-only visits, medically necessary, don't include BP checks only, don't include lab only, don't include injections only, don't include they came in just to get a vaccine, only when they had a face-to-face medically necessary encounter with a provider. And then it is broken down provider by provider type. Only, again, I'll say it again in the dark green, count only face-to-face encounters. Because this is an equation. You get those visits too high, it is going to tank your rate. Do include your mental health telehealth starting 1/1/22, but do not include your medical telehealth. So when you're running visits, because medical telehealth right now is paid differently, it's paid outside of the rate, that visit does not go into your total visit count on this cost report. If it's paid outside of the rate, the cost doesn't go, the visits don't go. Reported by type of clinician. All clinicians working on a regular basis, regardless of whether they're a 1099 or W-2, have to go in here. The only physician services, there's a line on there that says physician services under agreement. That does not mean paid by 1099. That means fill in for vacations, for leaves, for that kind of thing. If they work on a regular basis, even if they're paid 1099, they need to go up into the FTE calculations. How are FTEs calculated? Well, first of all, just be sure that when you're talking about FTEs, that you understand that FTEs means full-time equivalent. It is not warm bodies. It is not a head count. This is, I work 20 hours a week. Sally works 20 hours a week. We are one FTE. We are one full-time equivalent. And it is based upon available patient hours the practitioner is available to see patients. So if they are also running the office and they do their admin work on Friday afternoons, don't count that in the calculation of the FTE. FTEs must be by practitioner type. Here are the productivity standards, but I just want to skip right down to, I don't know if it's on this slide or the next. I'm going to just skip here to this top bullet, that it is applied in aggregate. Okay, so let's go back up here. 4,200 per physician, or employed or independent if they're regularly scheduled. 2,100 visits per PA and NP. physician services under agreement, now that is your locum tenens just coming in for little spots here and there. They don't go into this calculation. But remember, if you have, especially with some new employees that have not built their base yet or built their patient base yet, this is in aggregate. So if you have one physician, 4,200 is the minimum. If you have one PA/NP, 2,100 is a minimum. You have now 6,300. It doesn't matter who does those 6,300. That's your minimum as a practice. It is applied in aggregate. The total minimum is compared to what you did. Because I have to say this. Remember that little equation we've been talking about all afternoon or morning for you guys? Sorry, all morning. Cost divided by visits equals your rate. But that visit goes through a check first. It's a visits subject to a productivity minimum, and this is your minimum here. A lot of people will ask me, I get this question at least 3 or 4 times a year, what is the penalty? It's not that it's a penalty if you don't make the productivity standard. It just changes that number in the equation because it is the greater of your minimum or your actual visits that is that part of the equation. When you are doing FTEs, remember that those telehealth visits didn't count. The hours spent doing those telehealth visits don't go in. You need to pull those off that FTE as well. Back in 2020 and even in 2021, the max, they were not giving any sort of resistance to request to waive the productivity standard. I have not tested that on a 22 report. I expect them to go back to a more rigid interpretation to where if you don't make that, we used to be able just to give, COVID, it was the reason, and you always got the exception where they didn't apply that minimum. But as we go forward, I expect them to be applying that minimum again. Okay, we've done cost. We've done visits. Remember, visits is subject to a minimum. Do FTEs. Don't do pull off your admin time. Pull off your telehealth time. Cost divided by visits equals your rate, but we make a stop first at those pass-through vaccine costs. That's on B1 and M4. It is flu, pneumo, and COVID vaccines and MABs if you're doing them, the monoclonal antibodies. There's 4 pieces of data that you need for them. There's staff time ratios. You need the total you gave to everybody and how many of those were for regular red, white, and blue Medicare patients. And then keep your invoices. Those need to go in with the cost report. I'm not going to really go over you'll have these slides if you want to look, you really want to dig into how this vaccine time ratio is calculated. I will say this, when you are formulating that denominator for this ratio, make sure you include your physicians. I know it does not make sense because your physicians don't give shots. Why should I include their time? They don't give shots. It's because the result is multiplied by against healthcare staff costs that includes their salaries. You have to include their time because it's multiplied against a total cost that includes their salaries. Vaccine time ratios, another couple, just some hot tips for here. We have seen 10 minutes per flu and pneumo as an accepted. You could do time studies if you wanted to get that down a little bit. I recommend that you do time studies on how long it really takes to do your COVID vaccines and antibody treatments if you're still doing those. And then you're going to, again, divide the total vaccine administration hours, including physicians, time by total clinical hours. I'm going to just skim through this, but these slides, if you really wanted to step-by-step work through this vaccine time ratio, that'll be available for you on these slides. Make sure you keep your logs. Make sure you keep your invoices and submit them electronically if possible. For your COVID logs, Medicare Advantage, if you're still filing, like this morning I was filing a 9/30/22 report, so we still did have some Medicare Advantage COVID vaccines on there. As of 1/1/22, Medicare Advantage COVID vaccine should be billed to the Medicare Advantage plan. Before that, it goes on this cost report. So there was that cut. After 1/1/22, only those red, white, and blue Medicare patients' vaccines are passed through this cost report. Cost, visits, talked about some vaccines, giving you some detail to go back and read if you want. Rate. Now we're at the rate, worksheet C. Okay, this is input. You have to run a PSNR. You have to get signed up on their portal. It's a big thing to get signed up. Once you're signed up, it's pretty easy after that. But these are the things that you're pulling, and there's lines that they go on. It's fairly self-explanatory. Visits, deductibles, Medicare charges, preventive charges. Again, pulled from the PSR, MSP payments, Medicare payments. If you got any lump sum payments, it's got to go on that C series as well. Make sure you have those lump sum payments that they might have paid you at the time they sent you a rate letter. Sometimes they do those lump sums these days. And then also, this is where the pass through for bad debts will go. Here is a link if you're not signed up on the portal. Here's a help desk number, some links, some information on how to get signed up. If you are signed up, here's a nice cheat sheet that we've created. Hit this, enter that, apply this, continue here to run these kind of reports. And then once you've run them, just do a quick look. Does your PSNR match what you thought your red, white, and blue card Medicare visits were? And if not, do you have a billing problem? Do we have a Medicare problem? You know, why did they have 300 and I thought it was going to be 3,000? If it's off by a few, okay, maybe some timing issues. Did you count incidentals in yours? And if you did you also count them in the total? Because we need to redo that. Did you count dual eligibles twice? So if they have Medicare and Medicaid, did you count that as 2 visits? So this is a great litmus test on are you even in the ballpark with your visits? Did you count more than 1 visit in a day? Did a surgical procedure and an office visit and you counted it twice? So if your PSNR is off by much, you're going to want to dig in to be sure that you've done total visits correctly. For the pass-through for Medicare bad debt, I just put a few slides together to explain what that is. Just know that if you claim it, you have to have a complete log, that it is based on date of write-off, not date of service. You could have been trying to collect on this for the last 2 years. It goes on the report in the year you wrote it off, and it is only Medicare, deductibles, and co-insurance for regular red, white, and blue card. If you cannot tie it back to a paid Part A remittance advice deductibles and our co-insurance, it does not go on this report. I'll say that again. If you cannot tie it back to a paid remittance advice, paid claim, deductibles, and or co-insurance, it doesn't go on this report. It is not uncollected from other payers. It is not Medicare Advantage. It is not disputed claims. And in a nutshell, we have taken an hour and gone over cost reporting. Any more questions, Rondianne?
No, no, there are not any questions in the chat box at this time.
Anybody else? We got a couple more minutes. Just glad this is a Tuesday and not a Friday afternoon, right? This is my Friday afternoon, guys. So from here, I go spend a long weekend on a very large Disney boat with my 2-year-old granddaughter. So I am pleased to have rounded out my week with you guys. And I really hope that some of this made sense. But if it didn't and you just got some questions, just shoot them to me.
You have one more question, it looks like. What are the most common big mistakes you see with cost reports?
FTE calculations, overcounting visits because they have counted dual eligibles, they've counted nurse only, BP only. Those are the top 2. I would say just right off the top is overcounting visits, and not doing your FTEs right, especially, when you're close on that productivity standard in aggregate.
Okay, well, Julie, it's 12 o'clock. Thank you so much.
Great. Anytime, anytime. Again, there's my contact information. Feel free to reach out. And I'll see what I can do to answer any other questions if you have them.
Where are Medicare payment letters set to?
They're usually sent to the clinic or to the hospital. Sometimes they're sent to the folks that set your clinic up. So if you had some hospital administrators that did that, but normally they're sent straight to the clinic. If you don't have them, most of the MACs have a box, like a general email box, like I know Noridian has one. I don't know who, all your MACs would be, but most of them have some general boxes where you can say, hey, I need a rate letter, or I need to see this, or I need to see that. But they normally just go to the clinic address or to the administrator on file.
Okay, she said thank you. Thank you everyone for attending today. Great presentation, Julie.
Thank you, Rondianne.
Goodbye, everyone.